Alright, y'all, so this is another video I'm doing. The last one I did was about a car loan. This one is for a mortgage. So I'm going to show you how you can pay off your mortgage early using velocity banking is what it's called. And overall just using your income and your debt tools. So, or your cash flow, your extra cash and your debt tools. So let's get started. So right here are all the mortgage details. So let's say you purchase a home or condo or something for $200,000. The interest rate on the mortgage is 3.5%. Years is a 30-year mortgage. That will make your payment at 898.09. Over here are your debt tools, which are what you're going to use to help you pay off that mortgage faster. So you got our credit card. So let's say we have a credit card or credit cards. It can be a number of credit cards, but spread across, they all add up to 40,000 in this scenario. And let's say you have a line of credit, a personal line of credit. The interest rate is 10%, and let's say you have it at $20,000. Now keep in mind this mortgage or this example goes over a number of years, which I'll get to at the end. But so your line of credit usually don't last past, I think, about 10 years. But let's say in this example you just had it. Let's say you renewed it after the 10 years or whatever, right? And then let's say over here you have a budget. Your income is $5,000. This is after your taxes. Let's say you have a job. This is what you receive after your employer withholds your taxes. So let's say you have $5,000, right, coming in your bank account, and your expenses is $4,000. So you have extra cash of $1,000 every month, right? So yeah. So let's go down here. So here this column is your month. This is just showing which month you're on. This column is just telling you which month it is. These are the type of transactions. So you got your chunk. This one is going to be a first chunk. We'll get to that. These are your expenses for the month of January, and these are your paychecks. Let's say you get paid twice a month, in every month. So January, February, paycheck 1, paycheck 2, right? And then this is the credit card payment. So all expenses made in January. This is the credit card payment, right? We'll get more to that. And so this column is your bank account. Now your bank account, I just have this here because you're not even going to use your bank account really, but I just have this here just to show you that if you can, you should have about three months, at least 3 months of your monthly expenses saved up. So 4 times 3 will give you $12,000. So I just have that here, just to so you can see. This right here is the line of credit. So these are the transactions that are going to be happening, or the numbers in the transactions happening with the line of credit. This is the credit card column. So this column has the numbers and transactions with the credit card. This is the mortgage column, same thing, numbers and transactions with the mortgage. And this is your net equity, right? So right here you start out with your mortgage $200,000, right? That's a negative balance. And then your bank account is $12,000. It'll give you your net equity of negative $188,000. So we're going to work that down. So now, a couple of things I want to point out. Well, let's just get into it because it's a lot going on. So let's say you're at the beginning of January. You just purchased your house, let's say. And now, using this strategy, we are going to use our line of credit, which has a $20,000 balance. And we're going to make our first chunk, our first big payment towards the mortgage. So let's say you take $4,000, negative $4,000, and I'm doing this with the amount of I'm kind of doing this with the amount of expenses that you have. Expenses are $4,000. your line of your first chunk, you're going to make 4,000. And keep in mind, your line of credit, you don't want to use too much of it because that'll affect your credit utilization. So in this example, it's going to be negative $4,000, which would be 25% of your line of credit. Typically, you want to stay below 30% or below across all of your credit accounts. So we're taking 25% of the line of credit. So we take negative $5,000, negative $4,000 from your line of credit, right? And that is going towards the mortgage, right? And then the next column you're going to have is your expenses. So all of your expenses for the month. Okay, so yeah. So right now you have negative $4,000 on your line of credit. So now you know you have to pay that back, right? Now your expenses, you want to put as many expenses as possible on your credit card. Now we know everything can't go on a credit card, rent, mortgage. Sometimes you can't pay those things with a credit card, but you're going to put as much as you can on a credit card for the month. That way you don't use as much. That way your balance on your line of credit is not too high, because remember, you're being charged 10% interest on it. Now the interest that it is, it won't be that much if you do it the right way, because this is going to be a simple interest charge using the average daily balance method. So just keep that in mind. We don't need to get too much into that. But when you're doing this kind of debt paying thing, you want to get the right type of line of credit or whatnot. So now let's say okay, so all your expenses you're going to put on the credit card, right? And as long as you pay that credit card off by the end of the month, or the next month when the credit card is due, then you're keeping it, you're keeping your line of credit balance low. And so then also keep in mind right here, from your expenses, you're going to have some of that going towards your mortgage payment, right? So some of when you make that $898 payment, some of that is going to be towards the principal. You're going to have some going towards the principal, some going towards the interest. So here's what will be your principal part, right? And I got this using a calculator, so these numbers are accurate. So this is also helping to reduce your mortgage, right? And now when your first paycheck comes in, you're going to put that directly towards the line of credit. You're not going to put it in the bank account, right? You're going to put it towards the line of credit. So this is what's going to keep your line of credit balance low. So let's say you had negative $4,000 balance for like 15 days, right? January 1st through January 15th. So, but then let's say on the January 15th, you also get your paycheck. So when your paycheck comes in, you're going to send that paycheck towards your line of credit, right? And then let's say your next paycheck comes in, let's say January the 30th, you're going to put that towards it. So that negative 4,000 plus the 2,500 plus the other 2,500, you're going to have 1,000 now on the line of credit. So it's like your line of credit is over now in a sense, right? But you're still going to use that line of credit. So it's, just keep this $1,000 in there, right? And what you're going to do is wait till it builds back up to the amount of the chunk you want to make, right? Or in this case, I'm using the amount of expenses, right? So once it gets to negative 4,000, remember that first chunk we made was 4,000. So once it builds back up to 4,000, then you make that second chunk, and you just keep repeating the same thing, right? And so now at the end of January, your bank account, remember, you're not really using your bank account. This is just your nest egg, you just to have your 3 months worth of expenses, in case anything happens or whatever. You want to have some safety. I just have this here just so you can see, so your line of credit, now you have an extra $1,000 in there at the end of the month. The credit card balance is negative 4,000 because remember, you were putting all of your expenses on the credit card. So but remember, now your credit card is not being charged interest Not necessarily, because if you make the payment by the end of the month, then you're not going to be charged any interest. So you're putting as many expenses as possible on the credit card to keep the line of credit balance low, right? And so now over here, your mortgage has been reduced to 195, and your net equity has been so your net equity, it's been decreased, right? The negative 188 increased to negative 198 because of the credit card, but it didn't really increase. You just have to make the credit card payment. But let's just continue. So now February, let's say February comes around. Let's say February 5th, you're going to make that credit card. February 15th, let's say you're going to make that credit card payment, and you're going to use the line of credit. You're going to take a negative $4,000 from the line of credit, pay off the credit card, right? Then your expenses throughout the month, you're going to continue. You're going to put it on the credit card. Put it on the credit card. And then remember, some of those expenses are going towards the mortgage payment, the principal part. And then they say you get your first paycheck, let's say like on the 15th, let's say February 15th, boom, get $2,500, put it towards the line of credit account. Get your second paycheck, put it towards the line of credit account. So now at the end of February, bank account's the same, not touching it, but now your line of credit has increased to $2,000. So remember, every month you have that extra $1,000 from your income minus your expenses. So the extra cash is helping you build back up your line of credit so you can keep making chunks, right? And so you can keep knocking down the principal of this mortgage. And so if we keep going down, remember now, since we're making chunks of $4,000 and we have an extra cash flow amount every month of $1,000, then it's going to take us 4 months to build this line of credit back up to 4,000, and so we can make that next chunk. So you see, at the end of January, 1,000. In the February, 2,000. In the March, 3,000. End of April, 4,000. Right. So now we build it back up to 4,000. We're gonna make that next chunk, and you wanna remember, you gotta build it back up, because you don't want to use too much of your line of credit. So you don't want to just toss the whole 20,000, and it's going to affect your credit utilization. So once it builds back up to 4,000, that's our range for our chunks. What we're going to do is make that next chunk. So see right here, it says credit card payment and chunk. So you're going to make the credit card payment and the chunk right here. So that's, instead of negative 4,000, you're going to have negative 8,000. Half for the credit card, half for the mortgage. So you make that chunk, and you make that chunk, and then your expenses, again, you just put your expenses again on using the credit card. Put as many expenses on the credit card as you can. Now see your principal amount. That's the principal part that's going towards your mortgage. It's increased, it kind of did a little jump from 329 to 342, right? Because you made that $4,000 chunk. So now it's the same thing. Paychecks, you put it towards the line of credit to keep that balance low, so that way you don't get charged that much interest on the line of credit, right? And then you have to pay a monthly. You have to make a monthly payment on the line of credit, but when you put your paychecks towards the line of credit, that is like that monthly payment, right? And so yeah, again, you basically just doing the same thing. You see the $1,000 at the end of May, and then you just building it back up. June, 2,000. In July, 3,000. In August, 4,000. And then you make that third chunk, right? And so you see the mortgage is decreasing. The mortgage principal is decreasing. And your the principal part of the mortgage payment is increasing too. It's making jumps every time you make that chunk. And then your net equity is also increasing. Over here, it's negative 189, negative 187. So it's increasing, right? And so you just keep doing that You keep doing that, right? And then if you kind of just do like let's say your mortgage is 200,000, so 200,000, let's say every chunk is $4,000, so 200,000 divided by $4,000 is 16. I think it's about 16 years, right? So that'll give you a good estimate of how long it'll take you to pay that off. And so, but with these extra, remember you got the extra payments from the regular expenses. When you make that regular $898 payment, part of it is going towards the principal as well. So you got that and your chunks, and so that time from 16 years is going to be reduced even more. So you just basically keep doing the same thing every year. So I did all the calculations. I put all the numbers. You see the principal part it's increasing now, 500, 600. See, and so you just keep doing the same thing. You make those chunks, and then you start building that line of credit balance back up, right? Back to 4,000. Then once it gets to 4,000, you make a chunk again. So every 4 months, there's a chunk. So 1, 2, 3, 4 chunk. 1, 2, 3 chunk. 1, 2, 3 chunk. Well, really 1, 2, 3, 4 chunk. 1, 2, 3, 4 chunk. 1, 2, 3, 4 chunk. You see, so that's how it's going to go. Your principal balance is increasing. The principal part of the payment is increasing. Now it's at $800. Keep going down, right? And these are the months. These are the number of months, right? So now we're getting towards the end. So now down here, your mortgage balance is down to negative $3,469. So you brought that down after 155 months. And so now, since your line of credit is built back up to 4,000 again, and now your mortgage is only negative $3,469. So you don't even have to use the entire part of the chunk, right? You don't have to use the entire 4,000 for the chunk. You're just going to use the negative 3,469. So we got negative 7,469 here. 4,000 comes from the credit card payment, right, for the expenses from the prior month, and then negative 3,469 comes from the mortgage to pay off the remainder of the mortgage, right? And so now down here, your expenses have been reduced because you don't have to make that payment anymore, that $898 payment, because you paid off the mortgage. So now your expenses are only negative $3,101. And so now you got an extra cash flow of that $898 that's going to help you build back your line of credit. So you're done with your mortgage. Now you just have to build back up the line of credit because you still owe the bank for using that line of credit to help you pay back the mortgage. So now you basically just keep doing the same thing you were doing before, putting all your expenses on a credit card. Your paycheck, you're gonna put it in the line of credit to keep that balance low, so you don't get charged that much interest, and to help it build back up, right? And once you build that back up, you see your net equity over here now is positive. So it went from negative 1,571, now you're at $326. So you just have to build that back up, because the chunk now is negative $346.9 up here. So we just had to build the line of credit back up to this amount, right? And so right here, this was our this was the end right here. Once you see the net equity, and you see a line of credit build back up to $3,428, that's it. And so down here, you just have made that final credit card payment. You still had to pay that credit card back. Took that out, and then your line of credit is left with this balance right here, $326. So now you can shift this $326 back to the bank account, because you're done. You're done with the mortgage, your credit card. You're done. You use the debt tools effectively, and that's it. And so down here I have the approximate mortgage interest saved, which would be $44,000. Your approximate line of credit interest is -$500. And see, you're not being charged that much interest, because you're keeping your balance low on the line of credit, because you keep putting your paychecks towards your line of credit. So that's keeping your balance low. And you're also putting as many expenses on a credit card throughout the month, right? And so, it's like your expenses is not even affecting your balance on your line of credit, because you're keeping it on the credit card. So that's why you use the credit card. Okay, and then you do the line of credit to do those chunks. And use the line of credit to do the chunks as opposed to a credit card, because a line of credit has a lower interest, and the type of interest is different. See, it's not compounded like a credit card. It's using, well, you want to make sure you have a simple interest line of credit, and that is charged using the average daily balance method. And you probably want to see if you can get a fixed line of credit as well. That's what I pretty much use in this example. Now, obviously, we know that it can fluctuate a little, and I kind of already adjusted this for the like if you weren't able to put all the expenses on the credit card and some had to be used for the line of credit, I factored that into this approximate line of credit interest. So it's really not gonna be that much as you think. As long as you keep your balances low, it's not gonna be charged that much as you think. So this is your total interest saved approximately. And then the time to pay off the mortgage was 12 years and 11 months. So as opposed to 30 years, pay it off in 12 years and 11 months. And the time to pay off the line of credit was 13 years and 1 month. So it's basically just like 2 months extra to pay off the line of credit, right? So, and of course, this is just in this situation. Every situation is different. It depends on your extra cash flow, your income minus your expenses. That's a huge help. The amount of income you have and everything like that. It's a couple of things that go into it that could affect this situation right here, these results. But hopefully you guys understand this. I used the actual numbers from the actual, you having a mortgage. If you were to do this, I use the actual numbers, right? So 158 months down here, 13 years, 1 month, pretty much. And yep. So hopefully you guys learn from this. I'm not telling you to definitely do this. I'm not saying this is the best way to do it, or I'm not telling you like this is definitely what you should do. Pay off your mortgage, man, get rid of debt. I'm not saying that. I'm bringing this as a scenario to you in case you are interested in paying off your debt, but you may want to invest. Who knows? I'm not telling you, hey, paying off your mortgage is always the best thing to do. Because if you can invest and get a greater return, then you got to think about that as well. So you can't just jump at any one thing. It doesn't always make sense just because you want to paying off debt is not always like the best thing to do. Like, yeah, it's good to have little debt, as possible, whatever, but this is not always the best, let's say. Because if you found an investment that can, 10 times your money, and then you could pay off your mortgage in 3 years as opposed to 12, 13 years. So then it makes sense to go that route. So you got to put other things into consideration. But anyway, I'm not going to make this too long. This is not financial advice. I'm not a financial advisor. Just give you guys a scenario showing you how these things work, how velocity banking works. And yeah, that's pretty much it. If you got something from this video, consider liking, commenting, and subscribing, and I'll see you guys in the next video.